Welcome to Accounting 101, where we explain accounting in simple terms. And today's lesson outcome will just be defining accounting, the principles of accounting. What is this accounting equation you keep hearing about? And the main financial statements that we can go into. But before we even get there, what is accounting? Wait, what is accounting? Accounting is simply the process of recording financial transactions pertaining to a certain business. For the rest of this video, we're going to talk about our business, a small business of ours, selling pencils. And so accounting is all the processes that are involved in recording the transactions for this pencil business. And it's important for us to know why do we do accounting? It's for us to track financial transactions and to also manage finances. So those are the finances within our pencil business and our transactions. If we've sold 10 pencils today, or we've sold 5 pencils and we bought 100 pencils, those are our financial transactions that we're trying to track and see how they're going. And from that, we can make informed decisions. And that can be seen in 3 types of accounting. That is the financial accounting, managerial accounting, and cost accounting. We will get into that in a different video. But for today, remember, there are 3 types of accounting. And the importance of accounting is to track, manage, and to make informed decisions. The issue of principle. In life, we say we live according to certain principles. Why not in accounting too? In the accounting world, there are many principles that are stated to live by and to follow as you do accounting processes. And the 5 ones we're going to deal with that are most important are the accrual, consistency, going concern, matching principle, and the revenue recognition principle. With the accrual principle, this is simply you recognize revenue when earned and expenses when incurred. So if you earn revenue today by selling 10 pencils and the expenses of those 10 pencils, that's the situation of accrual principle. With consistency principle, however, we use a consistent accounting method to ensure accurate financial reporting over time. In the upcoming videos, we'll show different types of accounting methods and different, for example, depreciation. You can use a straight line method or reducing balance. The consistency principle will then say you need to use one method consistently because you cannot compare if you're not using the same things. It simply doesn't make sense. Our third principle is the going concern principle. We have to assume our pencil business will continue operating indefinitely. So then that's how you're able to create the principles and their financial statements. And the matching principle comes in next. We need to match the revenue we make with the expenses for the related period. So in 2024, if we sold 50 pencils, and we have expenses for 100 pencils, that's within the same year, and we have to match those. And last but definitely not least is the revenue recognition principle. We recognize revenue when it is earned and realized, regardless of the cash receipting timing. This means in a situation where a person comes and buys our pencils on credit, we recognize the revenue has been earned when we've given and the respected party has received the pencils. That is revenue recognition. As much as they may pay in next year or in the next coming years, the revenue is recognized in 2024, not in 2026, if the cash will arrive in 2026. We'll get into it a bit more and more examples about this. But for now, just remember, revenue is recognized in the year that you earn it, not when the cash actually arrives. Another important part is the accounting equation. Why do we have this accounting equation? The accounting equation ensures that a company's financial records remain balanced and accurate by maintaining a sort of equilibrium between its assets, liabilities, and equity. This accounting equation we're going to use often, so remember it. Assets is equals to liabilities plus equity. Simple. And last but not least, we've mentioned that, okay, we're going to recognize this. We're going to use the matching principle and the accrual principle. But where are we using them? We use this in our main financial statements. As we continue, we'll see what goes into the income statement, what goes into the balance sheet, and what goes in the statement of cash flow. But all these serve a purpose in people understanding, and you as the accountant or the one reading the accounts, you are able to then understand what has been put in which statement, such as the balance sheet. It provides a little snapshot of a company's financial position, including the assets that we have in our pencil shop, the liabilities, and the equity. We also have the income statement. It shows the company's revenues, expenses, and net income over a specific period. So within a year, within a month, within a quarter. And we also have the statement of cash flows. Now this one, it summarizes a company's cash inflows and cash outflows from their operating, investing, and financing activities. See you on the next video when we talk about accounting in simple terms. Thank you.